Achieving absolute global economic dominance has come with a mathematical penalty. Reaching superpower status carries the eventual destruction of that nation's currency. We can trace this specific mechanical failure back through every dominant empire in modern history. It dismantled the purchasing power of the Portuguese real and systematically eroded the Spanish peso. As global trade shifted, the Dutch guilder absorbed these same structural pressures and ultimately collapsed under its own weight. By the early 20th century, the British pound controlled global commerce. Yet despite holding the greatest territorial and financial empire on Earth, the pound followed this same trajectory into severe devaluation. The United States dollar has operated as the unchallenged global reserve currency for 81 years. When you align the macroeconomic data of the modern U.S. economy with the historical ledgers of the British Empire or the Dutch Republic in their final decades, the numbers match. We see the same trade deficits, the same sovereign debt expansion, and the same central bank intervention. Today, the US dollar is currently exhibiting the exact specific macroeconomic signals that preceded the fall of its predecessors. This historical pattern operates as a structural algorithm, independent of political accidents or specific leadership. Every imperial currency follows a 7-phase life cycle, from its initial military backing to its final inflationary collapse. The mathematical engine driving this cycle is known as the Triffin dilemma. The Triffin dilemma is the economic conflict that arises when a national currency also serves as the international reserve, forcing the host country to run persistent trade deficits to supply the rest of the world with liquidity. By deconstructing these 7 phases, we can map where the dollar sits in its life cycle and define the specific asset architecture required to shield capital from this process. Phase 1 begins with leverage. A single nation establishes absolute military and commercial supremacy, producing goods and projecting power at a scale no other country can match. In Phase 2, global trade networks centralize around this superpower, relying on its infrastructure to generate wealth. Doing business across borders using dozens of fluctuating regional currencies creates logistical friction. International markets naturally default to the superpower's money to improve efficiency. This leads to Phase 3, official adoption. The international community formally recognizes the superpower's money as the definitive global reserve standard. The moment a nation achieves this level of financial dominance, it simultaneously triggers the mechanism that leads to its eventual decline. Once a currency becomes the global standard, the host country is obligated to supply the rest of the world with enough liquidity to keep global trade moving. To physically move that currency out of its borders and into foreign hands, the superpower must buy more foreign goods than it sells. This is the core of the Triffin dilemma. To lubricate the global economy, the superpower must run massive, perpetual trade deficits. As the currency flows out, an overwhelming flood of physical imports flows in. Because foreign goods are pouring in cheaper than they can be made domestically, the superpower's manufacturing and industrial base begins to hollow out. The economy shifts from producing tangible goods to managing financial services.
The math here offers no simple exit. Stopping the deficits would starve the global economy of liquidity, while continuing them leads the host nation toward insolvency. Sustaining the global economy through a reserve currency eventually forces the host nation to sacrifice its own industrial strength. This transition leads to Phases 4 and 5. With its domestic manufacturing base weakened, the superpower's tax revenues begin to stall, and it resorts to explosive debt creation to maintain its global military and domestic programs. Phase 6 is the point where the total debt load becomes so massive that the government can no longer cover interest payments through organic economic growth or taxation. The government typically responds to Phase 6 with quantitative easing. Quantitative easing is a monetary policy where a central bank purchases government bonds to inject freshly created money into the economy to cover the deficits. Expanding the money supply without a matching increase in domestic production leads to Phase 7. Severe systemic inflation. The value of every unit of currency drops. Persistent inflation erodes the mathematical trust of foreign nations. They realize the purchasing power of their reserves is melting away, leading to a loss of global confidence in the currency. A $34 trillion national debt and sustained CPI spikes mirror the final phase indicators seen in every fallen empire before this one. The 81-year unipolar era of the US dollar is approaching its mathematical conclusion. We are transitioning into a multipolar monetary system where global trust is decentralized. Central banks are increasingly hoarding physical gold, while bilateral trade agreements begin to bypass the dollar. Because Phase 7 requires aggressive money printing to service the interest on debt, holding wealth exclusively in fiat currency results in a permanent loss of purchasing power. Traditional models like nominal sovereign bonds offer little protection in this environment. Nominal sovereign bonds are government-issued debt securities that pay a fixed interest rate, meaning their real returns turn negative when inflation outpaces the interest paid. Continuing to hold wealth exclusively in a depreciating reserve asset exposes that capital to the sustained erosion of purchasing power seen in every historical transition. Navigating this shift requires specific capital reallocation. Tactic 1. Shift exposure toward hard assets and commodities. Tangible assets like energy, heavy industrial metals, and agricultural goods cannot be printed by a central bank. Their value is tied to their physical utility rather than the solvency of a superpower. Tactic 2. Investors must decouple their wealth from single currency risk. This chart shows how to achieve this decoupling by utilizing geographically diversified instruments, such as globally distributed ETFs. An ETF, or exchange-traded fund, is a pooled investment security that holds multiple underlying assets and can be bought and sold on exchanges like an individual stock. Utilizing algorithmic trading systems and data-driven passive investments across emerging markets allows a portfolio to absorb the volatility of a reserve currency transition. Understanding these 500-year macroeconomic cycles is the only mathematical way to outpace systemic inflation and protect your savings in a multipolar world.